Well, hello, everybody. It's a very serious room. It feels intense around here. We're going to try to have a little bit of fun. My name is Frank Lonardelli from Arlington Street Investments. I want to thank, before we get going, the PCMA for not doing the cannabis panel before the real estate panel. I talked to Ross Bagliotti. He said he was going to be giving away gummy bears. Although maybe being stoned is a good idea in terms of being involved in the real estate panel. I actually think that real estate is probably the most important panel because we are directly connected to real estate as Canadians. And so what I didn't want to do today is I didn't want to have some formulaic, hey guys, let me send you a bunch of emails and tell you what I'm going to ask you. Then they get to think about it. Then they give you this really polished answer. I said, let's have some fun. And the good news is we actually have some very talented people we're going to have some fun with. So we have chosen a very, very difficult business, haven't we? We have two things that we get judged on. One, generating returns. Two, mitigating risk. It's not a business for everybody. It's a business for the select few, and I think we've got some very good people to talk about that specifically today. I'm going to do one thing and one thing only, and that's ask why. How you doing over there, guys? You guys in the corner over there. You guys good? All right, thanks. So, you know, these guys, a lot of people flew around here to get down here. We want to get a little bit of time with them. So, thanks for checking in. We want to ask one very simple question. That question is why? Why are we investing in these four guys? And why are these four guys investing in what they're investing in? And how are they mitigating risk? So let's have a little bit of fun. Without further ado, I'm going to introduce you to these gentlemen. They're going to tell you who they are. First, John Kortliff, Managing Director from ICM. Jason Jogia, Senior Managing Director, Chief Investment Officer at Avenue Living. Curtis Pot-Yondi, Prestige Capital. And Cameron Reid, CIO of Wealthco. Gentlemen, let's go from my left to right. Maybe just tell us who you are and what your business is involved in.
All right, my name is Cameron Reid. I'm the Chief Investment Officer at Wealthco, and we are a wealth manager for high net worth private client families, most of whom are here in Alberta. Okay, we build broad portfolios for our clients. Roughly half of our capital is invested in public capital markets, or what we'd call traditional portfolios, but there are meaningful investments in private securities, which is in part why we're here today, and of course, a good portion of that is real estate.
My name is John Kortliff. I work with ICM Asset Management. ICM is an investment manager focused on alternative assets, most specifically on real estate. And we invest in real estate through a series of limited partnership and similar type vehicles on behalf of everything from retail investors through to small institutional investors and family offices.
I'm Curtis Pot-Yondi. I'm President, Director, and Trustee of Prestige Capital and its fund. We're a hospitality company. We specialize in redevelopment of hospitality assets across Canada. We have assets across Canada, of course, and it's our function, it's our goal to make sure that we have a critical mass inside that space. So that's what our company's about.
My name is Jason Jogia. I serve as the Chief Investment Officer for Avenue Living Asset Management. We're first and foremost a prairie real estate story. We are 7,700 units amongst 300 buildings in 18 markets in the prairies, all multifamily apartment style, a little bit of commercial, a little bit of ag land. Been in business for 12 years, 3 offerings, and about $1.2 billion in assets under management. Our investors are typically retail wealth all the way up to small institutions and high net worth, so that's what we do.
Fantastic. So we have a very interesting panel. 2 individuals are asset managers in various different asset classes, and 2 are actually niche investors, 1 in apartment and 1 in hotels. I am the only developer here, so I'll probably be asking the most provocative questions. Curtis. Curtis, and I want to start by saying Curtis is probably the nicest guy in the exempt market. It's probably the thing that's easiest to talk about with respect to Curtis. Curtis, I know your business. I love your business. I'm in the hotel business and have been there for 10 years. Hotels are metrics based on 2 very fundamental items, right? ADR and RevPAR. ADR, average daily rate, RevPAR, revenue per available room. And that, of course, is tied into market. I want you to talk to us a little bit about where your hotels are, how they're faring, and how you guys are dealing with the massively and quickly shifting economy with respect to Airbnb and all the gray market competition that you guys have.
Well, it's a great question, and actually it's one we get all over. Airbnb takes up about 1.4% of the annual global revenue for hotels. So they're really, in this point anyways, they're quite insignificant. However, on the other side of that coin, you take a look that Hilton and Marriott have both come out with new programs where they will now have an Airbnb component. So on one hand, they're saying they're not an issue. On the other hand, of course, they're adapting to it. You know, I don't really see it in our particular asset class, the way we look at it. We're not after the business traveler. We're not after the discretionary dollar. So it doesn't really affect our business plan too much. Airbnb is more of like somebody who would go to Canmore, that type of thing. It really hasn't penetrated the downtown markets, the airport markets, the commercial markets where we have our assets. So it is something that you always have to be wary of because people do shop across classes, of course, when they're trying to book a stay. But so far it's been relatively insignificant to us.
Right. A few more questions on that, but we'll follow up on that in a bit. Jason, I respectfully refer to your company as the private company aligned with Boardwalk. Now, Boardwalk being one of the largest publicly traded apartment REITs, has had the dubious distinction of being one of the most shorted stocks on the Toronto Stock Exchange over the past 2 years, mainly because of their connection to Alberta. Interestingly enough, over the past 2 quarters, most sell-side activity has turned into a buy-side activity. But what's interesting about your company, though you're similar to Boardwalk, you actually are almost going counter-trend. The trend being urbanization. More and more people are moving into the cities. And when I looked at your portfolio, almost your entire portfolio are in bedroom communities. You've raised tons of money. You obviously know what you're doing. You've been doing it for a long time. Help us understand how it is that you guys are doing as well as you are in these communities that seem to be left behind by most investors.
That's a great question. I think it's important to notice that the prairies, what we lack in population density, we make up in infrastructure. So there's about 6 million people that live in the prairies. You go along the Trans-Canada, there's tons and tons of cities along the Trans-Canada, and the question is always, will these cities be there in the future? And our answer and our philosophy for the last 12 years is yes. They are the hub to the spoke of what makes the prairies. The agri-industry, the light manufacturing industry, the light oil and gas industry, whether it be beef products to grains to anything, these centers are serving those communities. They're serving their own industries within them. We took a position and started taking our position and allocating 12 years ago and really have built up that over the years in these markets that we're in. We've gone through 2 recessions now where the headline risk and the bankers in Toronto used to say, well, Brooks is not going to be there in 2 years. Brooks is not going to be there because oil is $30. They're still there. The tenants that we deal with are that service sector tenant who makes 15 to 20 bucks an hour and can live very comfortably in our buildings. And the population bases of where we are really have stayed stable over the years. They've actually grown, and that's because there's just big other industry besides oil. So, although there are the trends of urbanization and more people moving, migration into small centers still is there. And if those centers weren't there, imagine having to travel from Winnipeg to Calgary to get something, or to Regina. Quite a far distance for anybody. Trading population in most of our centers are north of 3 times the local community. So people have to live there to service Canadians, service the 6 million.
Great, thanks. John, myself and my executive team toured the United States in the 3rd quarter of last year with a sponsor, and we got to meet pretty much every investment bank in the U.S. and had an amazing experience out there. When I came back from the U.S., I noticed this very specific distinction. American investment bankers are looking to do deals, and they're also looking to find the next franchise. In the real estate business, we call the next franchise the next John Roth, the next Sam Zell, the next leading developer and or real estate investor that they can glom onto, place capital to allow that individual to go out and do what he does best. In talking to you, it sounds like your company's done pretty much that. You've gone out and said, we want to find the right people first, and if we find the right people, we'll probably get the right deals. Tell us a little bit about your investment philosophy with respect to partnership, and also how you ended up in Mexico, a place where a lot of smart guys have had their heads handed to them.
Am I talking for the rest of the panel? I'll try to keep that short.
Sure.
So we do investing in Canada, the U.S., and into Mexico as well, as Frank alluded to, in a little bit of a different way. We are a real estate owner and operator ourselves. We invest in Canada and operate those assets in-house. we have a full suite property management team here that look after every aspect of our properties here. In the United States and elsewhere in Canada, we asset manage a lot of our portfolio as well, but in the instance where we are developing new assets, for example, in the United States, we don't have that capability in-house. We don't have that depth of bench in-house, but we bring valuable skills to the projects, and so we're looking to partner with best-in-class local or regional operators to deliver new product to market, and we basically are seeing the project from cradle to grave and have control rights in each of those projects as well to ensure that things are unfolding as we see best. And we operate the same way in Mexico. I mean, it'd be naive for us to think that we can go down to Mexico as a bunch of gringos and succeed. But we've been successful at partnering with local operators who, you know, are born in Mexico but educated in Europe and the United States at Ivy League universities and have gone home because they see opportunity. So we're fortunate in being partners with those people, and we think that we're really going to have a good run in that manner.
Perfect, thanks. So Cam's one of the most analytical people that I know. He might be the second nicest guy on the panel. And has a very interesting way of... John, you're currently being judged. We'll tell you where you land at the end of this panel. Cam's actually one of the most intelligent guys. If you actually want to talk about the banking system and the history of finance, take him out for dinner. You'll be pleasantly surprised. And what's interesting is I actually asked Cam a couple questions, and then instead of me thinking I should ask you an intelligent question, you just sent me the question to ask you, so I'll just ask you that question, which is actually a real simple one. You know, when Cam and I were talking, he's like, so there's really kind of 4 buckets. I'm only going to talk about the 3 you talked about, and you can give me maybe 2 points per bucket, okay? So bucket number 1, do we have a good partner? Sounds pretty simple. Not so much, right? Number 2, do we have a good project? Whew. And number 3, do we have a good deal? So maybe give me 2 points in each one of those 3 categories so the audience can think about how it is that you determine these deals.
Right. And so we kind of view this as a stool, right? If any one of those legs is missing, the stool's going to fall over. You're not going to have a great experience. Really important. What makes a great partner? And, you know, a lot of that speaks to values and culture, okay, more than anything else. But you want someone who's built a team of successful professionals that has the capacity to carry the project through to completion. And look, we all get into an investment with the expectation that things are going to go as planned, but life throws things out at you. And there needs to be the depth of resources and the commitment, okay, for that team to navigate whatever uncertainties present themselves while you're in that value creation event that we're investing in. The second thing about a good partner, you need to know they can raise all the capital that they say they're going to raise. And in that sense, you have to understand, are you the first dollar in to this deal, or are you the last dollar in when everything's available to get the project all the way to completion? And this is important because if you get into, you know, if there's an $8 million equity raise to build a building and they only raise $2 million, you're not going to have a good experience. So there's all sorts of capacities that come to play in the partnership, but you want a track record and you want really both financial and human capital there that can be aligned with you as an outside investor. Good deal. You know, you're looking for alignment, okay? And in our sense, our clients and us as investors want to be there for the value creation event. And so we're looking at, you know, how do the economics work, and are we going to get a good exit and on good terms, okay? Typically, you don't want too much of a promote, okay? A successful developer doesn't need to get rich on the first deal. So they should be willing to, look, commissions could be 0 or close to 0, all right? You want a reasonable management fee so that they can keep the lights on, pay their staff. That's entirely fair. But we want incentive economics so that when we crystallize the value creation event, we all share in that. And that's the incentive so that they're, you know, because the economics of holding fully stabilized real estate is actually difficult. Because if you've got a great location with a well-maintained building that's properly managed, you know, your future returns are not the same as coming in and doing the value creation event. A good project. Okay, what is the value creation event? In our view, they come in 2 categories, right? One, you are coming into a mismanaged asset and applying management talent and capital to turn it around. But you have to have the ego that says we can actually manage better than they did. Okay, and that has to be credible. The second one is that you're building something that's never been there before because you either believe that the city's going to grow, okay, and this infrastructure of real estate's needed, all right, or you're adding density to an established neighborhood. And it's important to understand the type of risk that you're taking. And for us, most of the projects that we've done have been applying density in great postal codes or great zip codes. And in our sense, our clients are already rich. Our job is to keep them that way. And investing in great zip codes and great postal codes and adding density means that the risks that we're taking are, hey, are we going to get the price per square foot in rents or leases or in sale value, not vacancy, right? If you're in the path of growth, you're speculating in a very different way. I'm not saying those risks aren't worth taking, but you got to be cognizant that growth might not go in your direction. And writing a newsletter to clients saying, we built a building and no one's in it is not a very exciting experience. Anyway, those are a few points.
Yeah,
Just to add to that as well, just
Sure.
the importance of a good project is your entry point. Your price is incredibly important, and ultimately you can have a great exit value, but if you paid too much on the front, it's not going to matter anyhow.
Yeah, well, this dangerous and mysterious word called promote. Promote's a definable term, right? What is the promote? How do you gauge it? How do you judge it? How do you earn it? Front end, mid end, back end on performance. From a developer's perspective, and I think this is important to say, you got to make 1 million decisions right to get a development right. And that's if the market goes with you. If the market doesn't go with you, it's probably 2 million decisions right. So there is lots of peril along the way. And on that note, I'd like to ask this next question to the entire panel. You know, I've always said about the exempt market is not supposed to be a venture market. It's supposed to be a growth market. In other words, you should never, ever, ever have a deal go to zero. Ever have a deal go to zero. But nobody bats 1,000, and we all got battle scars. So the real question, when we don't get what we originally thought we were going to get, we all call that experience, of course, but the real question is, what was the mistake? So I'm going to just guess, because I haven't asked these guys, that all of you made a mistake in your investment careers. So I want to move, of course not Curtis, besides being the nicest guy, he's never done a mistake in his life. But we're going to start over with Jason, and I really want them to be a bit vulnerable, okay, which is hard to do amongst all these kind of atypical people in the room who make so much money, right, is we've all made mistakes and we've also all lost money. So I want you to tell me about your worst investment mistake, how it happened, and what you learned from it.
That's a great question. You know, I think the one thing that you know, anecdotally I always say in the office is that it seems like we always do it the hard way. And what I mean by that is, you know, in our first, call it 10 years of our 12-year existence, the capital that we raised was always just in time, created equity by executing one in a row, building up our platform, creating value, you know, raising capital through notes or through friends and family, but we were always working out of a position of scarcity. And as a result, it was always very, very challenging. You know, 2017 rolled around. We were looking at our balance sheet at the time, and we were sitting there with near 75% leverage, and kind of thought to ourselves, like, you know, what's the next step? We're in a protracted recession. Bankers in Toronto are turning their backs to Alberta, left, right, and center. How do we do this right? How do we do this better? And the answer was going through the alternative investment space, going through the private capital markets, through the EMD space. You know, we raised $175 million this year in just 6 months. And, you know, you asked the question, what was the mistake? Why didn't we do this sooner? We could have built this business more solid, more stable, faster, quicker, stronger, had we had access to this capital market space that's in this room or represented by this room, had we entered it earlier. Now, the good news is the founders ended up making a lot more equity along the way because we did it the hard way. But now we like to try to take a better approach to our growth and growth on a stabilized basis, or grow on a stabilized basis. So that would be called the mistake with the solution, I would say.
Thanks. Curtis?
Well, I'll give you the same investing advice my father gave me, and that's worry about the return of your money, not the return on your money. And if you work on those principles, you're always going to be okay. And I wish I would have listened to that earlier in my life. My experience, my negative experience in investing came before the private capital market. I was involved with a large commercial greenhouse operation, and I got in too deep with national chains. They started to dictate my business I was with. I was a national supplier to Home Depot, Costco, Walmart, on and on. And you don't realize what they do to pivot your business back on you. And I unfortunately went with one of them to sign a loan at a bank for an expansion onto my facility that they would, of course, fill up, take it every year, and all that kind of, you know, this kind of good talk, right? Unfortunately, when you get the time of shipment, and this is perishable goods, they have this unfortunate phone call with you that we don't want them. And then what do? Because you've made a custom product for a national chain, and your options are you can tell them to go take a hike. Of course, that's probably your next year's budget going out the door with them, and your reputation. So it becomes very difficult, and it becomes very undiplomatic as well. And you know what I learned is that you have to make sure that you're taking care of you first, and back to the old adage of making sure I have a return of my money before I worry about anything else, and that served me well ever since.
It's interesting, you know, you talk about who owns who. Had a little company called Craves Candy. You might remember a little product called Clodhoppers from Winnipeg, Manitoba. And they were dying to get on the shelf of Walmart. They finally got on the shelf of Walmart. Now we sat at the board, and I was an original investor. I said, holy crap, Walmart owns us now. And they schooled us on business for 5 years. It was unbelievable. So it's a huge learning experience, right? And that's control, and what that control looks like. John?
Yeah, I mean, we have a very similar philosophy at ICM, and that's, you know, take care of the downside and let the upside take care of itself. And we spend a lot of time underwriting what the downside might look like, what might have to transpire for that to occur. And if we feel that we can manage those risks, you know, we'll let the upside take care of itself. So very similar sort of philosophy. You know, we also manage the risk that our investors take with us and try to, you know, absolutely ensure that they don't have a negative experience over time by not actually selling projects, or we don't have any investors in one-off deals who are not very sophisticated investors in and of themselves and who are not diversifying their own portfolio adequately. So, you know, we do not push out to retail investors individual investment product. It's all fund-based. Because, yeah, you're going to have some things that don't go as well as you thought, and you're going to have other things that do exceptionally well. And it would be a real shame to have a bunch of different investors, all of whom invested $50,000 with us. You know, some did absolutely fantastic, and others are disappointed. So, with respect to a single challenging asset that we've had over time, and we've never lost money on a single real estate project that we've been involved with, but there's certainly some that have been very challenging. And you know, one of the ones that stands out is actually a project that I've had the good fortune, I say that somewhat facetiously, of looking after since 2012. It was a development project here in Alberta, and it's gone through 2 downturns. We removed the developer and took over ourselves, and it's just the gift that keeps on giving. But you know, honestly, I mean, that's also where you need to understand where you're investing along the risk curve as well. And I mean, development is inherently more risky than buying an in-place existing asset, and you need to understand those risks and be able to manage them, and to finance individual assets, you know, makes that all the more risky for the investor. So we're fortunate in that none of our investors have ever had a bad experience because they're not invested in a single project. We're fortunate in the sense that we've been able to manage the risks of every project that we've been in, to the point where we've not lost money on any single real estate investment, but we've had things that have ranged from, you know, 1 to 2% IRRs all the way to 30 to 40. So,
Right, great. Yeah, I think in Alberta, the new moniker is flat is the new upside.
Probably.
it's all perspective, right? If you're looking down this way, I mean, that looks up.
Yeah, yeah. Well, every day is a new day, every day is a new day when you're a developer, right, John?
Yeah.
Yeah. So, Cam?
Yeah, I could say.
Cam, I want you to dig deep.
I started my career as a stockbroker at a bank-owned IROC firm. And at the age of 23, I was eminently qualified to manage your wealth. So I can share with you lots of experience that I gained, say, trading stocks, but I think we'll skip that. Sure. It's also a bit of an art to figure out where you are in the cycle. And there are risks that you can mitigate and risks that are more difficult to mitigate. And quite infamously, I bought commercial real estate in Calgary in 2013 when oil was over $100. Okay, now that project will actually come to fruition, and we'll kind of, you know, we won't we won't be injured financially for it. But that's one of the risks that's just intrinsic in the investing event, is that you need to know where you are in the cycle and bet accordingly, okay? In other words, don't overbet or overcommit yourself to any one investment or any one view. We made that mistake. And to John's point, you always know the things that you've done wrong because they soak up all of your time. And so if you go back and look at your calendar, all your mistakes are like big chunks of your day. And we're going through a little bit of brain damage on a small position for our firm, but still meaningful, in a mortgage investment corporation that we bumped into 6-8 years ago. And it's a legacy position for us. It's, and some people that we introduced to the mortgage investment corporation. But we talked about partner. And I think the due diligence process that they went through was accurate, okay, and thorough, but there was an obvious sore point there, or just accident that could have happened, in that the team that was behind it, okay, the scale and scope of the organization was really not there to deal with the economic difficulties, okay, that happened here in Alberta, and really not capable to deal with more complex lending if you're into development. And so they stubbed their toe, and it's, like John's experience, it's a lot of brain damage to work that stuff out. And so being present about what the downside risks are, okay, and spending time, it's fun to be an equity investor because the upside is fantastic. But you need to spend a lot of time in a bit of a dark place before you write a check, okay, to understand just how things go bad, and if they go bad, what resources are going to be brought to bear. Okay, my own personal fear is that on Saturday morning I'm at Home Depot trying to fix a project. Okay, I have that image in my brain.
It's a bad image, Cam.
I know. My hands are very soft. It's not gonna
I'm not going to touch that at all. Yeah, so
You can't throw out softballs like that.
what's that?
You can't keep on throwing out softballs.
No, I know. It's a solid G rated today as well. It's interesting, and we're very thankful for the award that we won today. One of the difficult things about being counter-cyclical or counter-trend is trying to convince your investors to do things that they inherently are terrified with. So in 2009, we bought that little asset that we got the award on today. The barrel of oil went from 146 to 46. And there were no transactions in terms of commercial real estate assets in the downtown core for 2 quarters, that's 6 months. And so when we sold it to First Capital and all these big players came in and gave us the type of money that we got, and we were incredibly well taken care of with our investors as well, everyone said, well, how did you do it? And it's really difficult to convince investors to go into a burning house if they don't know what gear you're wearing. So it's a difficult part of our business and something we think about regularly. Okay, so we asked the downside question, right? My favorite questions when I'm talking to people who are smart like you 4 dudes and people who have made a lot of money, top 2 questions, best day, worst day. I don't think they gave us their worst day, but they tried hard. So we're gonna ask them for their best day. So the best day in the business that we're involved in is the investment. What was absolutely the best investment you've ever made? Why was it the best investment, and how have you benefited from it from that? And we'll start with Cam on this side.
We don't have any investments that perform as well as yours did. But on a risk, and it's hard to factor, you can always get the total return back out, but on a risk-adjusted basis, we were able to get into a mortgage. And it was just the B piece of a first mortgage, and it had the guy had a $100 million net worth, and we got about 18% rate of return. It's probably the best risk-adjusted return we've ever had. It paid up for 2 years, and we got all the money back. Good gig.
Right?
Yeah.
I was going to take a sort of similar path. I was not going to talk about the thing that returned us the most, but the thing that we felt best about on a risk-adjusted basis. And but Cameron's already done that, so I'll swing for the fences. We did a development in ICM did development in Redmond, Washington, in the early part of the 2000s, and it was a triple whammy, probably not dissimilar to what you experienced, Frank, where ICM bought it as industrial, and Microsoft was just down the street, so built Microsoft a campus and filled it up, got it fully leased. Swept out more than all the equity on the refinancing, held it for 6 months, and Microsoft came and bought it. So they bam, 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 and it was over the course of sort of 4 years, nearly a 50% IRR.
Nice.
It was just incredible. But anyways, but that was swinging for the fences. I mean, you're buying something and going through a change of land use, and then you're going through a full development, and you're very, very timely and fortunate with the end purchaser being there that quickly. So not all of those things line up, and that's a pretty unique circumstance.
Well, I'm the nice guy on the panel, so I'm going to go with something a little more touchy-feely than you guys. It's about 2010 in this story, and we have a piece of real estate out by the Calgary airport, and there's this new legislation called 31103, and we want to syndicate some of our equity with these EMD people, and we're not sure how to go about that. But we know what we want to do. We've done all of our best usage studies. We know it needs to be hotels. So now you go, you make the documents, because you talk to the lawyer, because that's what you do. You talk to people like Craig Skoggs, and he says, well, this is how you structure your deal. So you write it, and you think, okay, great. How does the money come in? Well, there's me in our little bus driving people around on this piece of dirt and taking them outside and saying, you know what, someday there's going to be a building here, right here. Believe me, it's going to be here, right? But fortunately, a lot of people in this room shared in our vision and supported us along the way. And it was really a culmination of so many stakeholders, everybody from the actual investor to the EMD to the infrastructure in our industry. And then as you start seeing the construction go, you start to think, you know what, this could actually happen, right? I think we actually are going to do it. And then you get to the point where you start hiring staff and you put the flesh on the building, and you start to see and you start to get the personal pride of walking around and going, yeah, I picked that out, right? Yeah, that's my color. Everybody else hates it, but that's my color, right? And then you get to the point where you're open, you have your grand opening, people come, they wish you well. And all that was great. But the best day about being in this business was the day that we gave the checks back to all the investors. Some of the people in this room were actually at the event. And what we did is we made these large checks, kind of like a lottery, lottery size. And everybody who had invested, they came up, and we had a big cake, and we had a celebration. And to see their joy and fulfillment come to fruition with us was probably the best day that I think I'll ever have in this industry.
Love it. Great. Thanks, Curtis. Jason?
I'm torn between two stories because they're win-wins for two different capital stacks, one being the debt holders and one being the equity holders. I'll start with the debt story, and I'll be quick, but we pride ourselves on being an operator first. We pride ourselves on being able to do value add and work out tough real estate. We had a lender who had some exposure in Winnipeg, high-rise building that we still own to this day. They gave us a call and over a dinner said, listen, we need some help here. We need you to help us work this out. We don't want a problem loan. Look at buying it for the debt. We'll keep the debt on there, put some capital, see if you can solve it. You've done it time and time again. And that building we picked up for probably 50 cents on what we thought it was worth. Put in about, quite a few millions of dollars to really turn that building in terms of CapEx, get some rent control relief in Manitoba as they have rent control, and really fill it back up with some good tenants. And that's become a pride of ownership for us in Winnipeg. But most importantly, at that time, the equity was our founder's equity. But most importantly, that lender, who's very, very large and has a national presence, has never forgotten the fact that we worked them out of that loan, refinanced them out, and avoided a problem for them. So that was a very big win for us, and that carries to this day. On the other side, for the equity side of the business, we always prided ourselves on going into diversified economies with the understanding that we would go in an oil and gas-centric economy if the price is right. Recently, and just this year, we stumbled across an opportunity in Bonnyville, Alberta, which is northern Alberta, about 2.5 hours northeast of Edmonton. We had been watching that market for a while, close to St. Paul, or close to Cold Lake in St. Paul, and never took a position, just too much correlation oil and gas. Well, we struck a deal at what we thought was the bottom for 306 doors. We now own most of Bonnyville at $22,000 a door. And we bought it at 20% occupancy. We are now today trending at 80% occupancy in Bonnyville. So really quite the multiplier for our equity investors, and a very good success story. And again, it comes back to pride of management, ownership, and operational excellence. So,
Jason, I love it. I got 20 seconds left. I'm going to squeeze this one question in. You got $100 million. Where are you investing?
175 million, still in the prairies, primary markets, Calgary, Edmonton, Regina, Saskatoon.
Curtis, if you got $100 million, where are you investing?
Eastern Canada.
John?
Spread, most of it's not here.
Oh, John, you're number 4 on the list right now. Cam, how about yourself?
South of the border.
South of the border. Thank you very much to the panel, and thank you for paying attention today. Good. Was it good? Good. Does this mean 5 more minutes?
Yeah, right. In your mind, yeah. Hold on, really good.
Good. Good. Glad you liked it.
You got the E factor going.
What's that next?
Key factors in considering evaluating mortgage investment entity.
Oh, good. You have fun? Good. Wanted to have fun with the boys today.
Well, I should just let you do the intro. I don't need to introduce it. Just introduce. Go ahead and introduce it. Yeah.
Are you, oh, I don't even have one. Okay, Neil, have fun. Thanks. Is this on? It is on. I think she turns it on and off.